What's going on, everyone? We're going to talk about the Organization for Economic Cooperation and Development, and of course, global value chains. I'm not sure if you've heard of them or not, but we're going to go over them in this video. I'm going to explain to you, we're going to walk through 2012 basically, through 2022, and I'm going to try to get as much of it as I can in here to where it's not confusing. And let's go ahead and see what this is all about. So, the Organization for Economic Cooperation and Development, we're going to refer to it in this video as OECD, is an international organization that works to build better policies for better lives. Our goal is to shape policies that foster prosperity, equality, opportunity, and well-being for all. We draw on 60 years of experience and insights to better prepare the world of tomorrow. Together with governments, policymakers, and citizens, we work on establishing evidence-based international standards and finding solutions to a range of social, economic, and environmental challenges. From improving economic performance and creating jobs to fostering strong education and fighting international tax evasion, we provide a unique forum and knowledge hub for data and analysis, exchange of experiences, best practice sharing, and advice on public policies and international standard setting. The global reach, member countries, as of today, we have Australia, Finland, Austria, France, Belgium, Germany. You can read the rest if you want. What's not on there, noticeably, is going to be two main countries that stand out. Well, three, but Russia's one. But then we have India and China as well that are not on here. So, the journey begins in 2012. Cited reference number 1 is going to be China in Focus, Lessons and Challenges. This is from the OECD themselves, written in 2012. So, on page 84, we see here that the shift in global markets and opportunities for China is what this part is headed. As the weight of the world economy shifts from OECD countries to emerging countries, it is likely that the end markets served by GVCs will shift as well, with China being the most prominent future end market. This shift will bring substantial structural change to existing GVCs and provides both opportunities and challenges for China's upgrading. So you hear that? Upgrading. We're telling you this as far back as 2012. Now, currently, the lower levels of per capita income in emerging countries require high cost efficiency from GVCs to remain competitive. On the other hand, demand for quality may be less stringent in such markets. This may appear to suggest that the source of competitiveness in such GVCs would be the capability for mass production rather than the ownership or control of key intangible assets. However, demand for quality and brands are rising quickly among wealthy consumers in emerging countries. For Chinese enterprises, competition with OECD firms is likely to be strongest in such markets. Focusing on the mass of consumers with the lowest income levels entails the risk of specializing in low-quality goods with limited value added, which will eventually be substituted by higher quality goods as incomes grow. The shift of global demand to emerging countries and the South more generally is therefore unlikely to alter the importance of technological capability and intangible assets in China's upgrading. On the other hand, the shift in end markets provides a valuable opportunity for Chinese firms to acquire a larger role within GVCs. I'm going to explain what GVCs are in a minute. Chinese indigenous enterprises have been developing their own designs and brands targeted to China's large domestic market and to other emerging markets. Such intangible assets will provide an advantage for Chinese firms compared with OECD firms that often have to adapt their products to emerging markets. By leveraging their expertise in domestic markets and in other emerging markets, Chinese firms can act as provider of new designs and concepts. However, firms from OECD countries still hold a strong technology and quality edge, and most established brands are from OECD countries. Many MNEs are also already developing products targeted to Chinese consumers. FIEs and firms from Hong Kong, China, Macau, China, and China hold a substantial market share in some industries ranging from apparel to transportation, machinery, and computers. Now, what are GVCs? Well, at the beginning of the video, I talked about the global value chain. They are international production, trade, and investments that are increasingly organized with so-called global value chains, where the different stages of the production process are located across different countries. So the key thing to take away is the different stages. GVCs is when different stages of the production process are located across different countries. So Chinese enterprises, therefore, must continue their investments in technological capability and intangible assets. The nature and extent of upgrading within new GVCs will be based on their ability to produce high quality but yet affordable products that capture the fast-changing preferences of Chinese consumers. This again points to the importance of profit-driven enterprises for China's future. Such enterprises are likely to respond more quickly to emerging needs and tend to be more efficient in translating ideas into commercial products. So then we move on to 2013. The reverse repo was born on the United States side. So the Federal Reserve conducted technical exercises using on-RRPs beginning September 2013 in order to gain operational experience and garner information about how such operations might be used during the policy normalization process. The on-RRP offering rate, the maximum interest rate that the Fed Reserve is willing to pay on RRP operations, plays a role for on-RRP counterparties that is similar to the role played by the interest rate on excess reserves for depository institutions. That is, in general, any counterparty that can use the on-RRP facility should be unwilling to invest funds overnight with another counterparty at a rate below the on-RRP rate, just as any depository institution eligible to earn interest on reserves should be unwilling to invest funds overnight with another counterparty at a rate below the interest rate on the excessive reserves. The Federal Reserve currently conducts on-RRP operations with many counterparties, covering a wide range of entities. Now, China is in the midst of a digital revolution. During the course of 2013, as we just read, the number of active smart devices grew from 380 million to 700 million. On Singles Day, the e-commerce marketplaces Taobao and Small posted more than RMB 36 billion in sales in just 24 hours. Some 5 billion daily searches are made through Baidu, and hundreds of millions communicate via web chat or WeChat, Tencent Mobile's messaging app. Now, with 632 million users and counting, the internet is fundamentally altering the fabric of daily life in China. So 2013 is when the reverse repo first showed up on the charts, and the first period of demand lasted between 2013 and 2018. We already know that the Organization for Economic Cooperation and Development has switched their focus from, OECD countries to emerging markets at this point in time. Now we're going to 2014, which is China's digital transformation is underway. Reference number 2, we have China's digital transformation, the internet's impact on productivity and growth. Basically right here, this is an automotive statement here, paving the way for new sales and service offerings. Since 2000, China's passenger car production has posted compound annual growth rate of more than 25%, and in 2010, China undertook the United States as the largest single country new car market. Supported by the rising number of high-income urban households and low automotive penetration, China is expected to contribute 35% of total growth in the world's automotive market between 2011 and 2020. By 2020, automotive sales in China are forecast to reach close to 24 million, a figure that would top sales in the European or North American market. Then we have chemicals. The Chinese chemical market has experienced more than 2 decades of robust expansion, posting a compound annual growth rate of 12% from 1990 to 2011 and reaching RMB 8.1 billion in 2013 sales. Already the world's biggest chemical market, China is expected to account for more than 60% of global demand growth from 2011 to 2020. Then we have an increase in remote working. Now keep in mind, this was written in 2014. 7 years basically since this was written. This is exactly what happened. Increase in remote working. The internet enables employees to work from home, allowing companies to take advantage of reduced requirements for office space. This trend could one day make central business districts less congested and expensive. According to a recent survey of 1,900 IT managers from 19 countries, 89% of organizations globally expect to offer more mobile work options by 2020. The same survey revealed that in China, some 21% of employees could already work remotely when needed, and 73% of organizations have partial mobile working support. The need for office space is expected to shrink about 20% by 2020. Remote working also allows companies to avoid heavy traffic, high rents, and the high cost of living in central business districts. Since the share of knowledge workers in China's labor force is increasing, remote working is becoming more relevant. The main hurdle to further adoption rests with companies themselves. While keen to save on rent, many still have concerns over the productivity of remote employees and favor face-to-face interaction. In the United States, Yahoo and Best Buy ended their remote working programs in 2013. Then we have healthcare. They're going to be expanding access to healthcare as well while lowering cost. As the Chinese economy has grown, the country's healthcare sector has consistently represented about 5% of total GDP. By 2020, the country aims to increase healthcare spending to 6.5 to 7% of GDP. The government has released a series of ambitious reform plans since 2009 when it announced its intentions to invest around RMB 770 billion in healthcare. 4 years later, China has spent more than RMB 2.3 trillion, with about RMB 620 billion going towards insurance, public health, public hospital reform, and development of community health centers. These actions indicate the government's determination to improve the quality of healthcare. Well, okay, so all that sounds great, but it's 2022. What happened? I know what you're thinking. COVID. Well, that's not the case. The whole thing this has been about is preparing for 2022, written in 2018, what you need to know about LIBOR transition. This is written by the Working Group on Sterling Risk-Free Reference Rates. And basically, LIBOR is an unsecured rate, and the switch to the SOFR rate, which is the United States' new rate, is going to be a secured overnight funding rate, which basically was back-tested in 2018, and it was a daunting global task. Now, SOFR is the repo, so it stands for Secured Overnight Financing Rate, and this is the reverse repo. Now, these changes were happening globally, explaining the supply rifts and the media narrative surrounding them about all this division going on. This has all been planned this whole time, and it's all working according to plan. We're moving from unsecured rates to forward-looking secured rates. Now, it's all about unsecured moving to secured. And forward-looking SOFR rates cannot be established without a certain amount of volume that's sitting there. So now you look at the repo chart and you see this here had to happen, and they just got where they needed to get to in order to get those international, because keep in mind we're building China's market, in order to do a forward-looking rate, in order to get all this inflation out where we need to go. In China and India, remember at the beginning of the video, the two countries that were not listed as the members of the OECD, it all lines up perfectly. Now, Jerome came out and said inflation's peaked. When was the last time they raised reference rates? The last time China had a bull market. The last time U.S. had a sideways market. So all this trade conflict going on, it's simply the final push for transitioning, easing the supplemental leverage ratio in 2021, is what you're seeing here. This little lull between activity. That was when the Fed monetary policy, the supplemental leverage ratio, was eased to allow basically a revolving door of credit for these big institutions to go and leverage up on everything under the sun, which is exactly what they did. Now think, what are we waiting on to be approved by the SEC after hearing all this? What is the one thing we're waiting on? An SFT center from the NSCC. You see, because the whole problem is that the Fed is the entity clearing in the reverse repo. In 2019, when COVID happened, right before then actually, it's actually about the end of 2019 going into the beginning of 2020, the interbank lending market basically died. So there was a big run on the money market funds, and they had to leverage everything up and basically hurdle it into the repo once the SLR relief expired in 2021. And going back to the chart, that's exactly what happened. Here was the leverage period, no demand, and as soon as that period ended, like the next day, all of a sudden we're all-time inflation, all-time demand in the repo, because it is the last push for SOFR transition. Now, SFTs are securities financing transactions, and they allow investors and firms to use assets such as the shares or bonds they owned or the ones they just bought, during 2021 and in 2020 during SLR. They can now use all those assets for a repurchase transaction, selling a security and agreeing to repurchase it in the future, basically the same thing as a repo, lending a security for a fee in return to a guarantee in the form of financial instruments or cash given by the borrower, and a buyback transaction or sell buyback transaction or a margin lending transaction. So now they got all these assets and they got all this risk. This is how they're going to funnel it in and back to the system. This is the LIBOR transition. It's the final push. That's all it is. So the media, the narratives, it's to keep you away from the opportunity. The Fed started clearing for the banks in 2019 due to COVID, and because the interbank lending market essentially died during that time period, this is why you see all this stuff going on. Now, this is just one piece of the puzzle. To fully understand everything that's been happening, you have to understand a couple more things that are huge. Again, The supplemental leverage ratio is a huge factor to look into, as well as the money market fund activity that happened prior to April 2020. Also, on the Chinese side, you have the 3 red lines, which is the forced deleveraging of Chinese developers, which happened between August 2020 and that just expired this year in January. And now, all of a sudden, it's all written there. You can't just say no with no argument. This is what's happening. DTCC's already got their SFT clearing up on their website. And again, I'll put this back from the beginning of the video. There is no issue. Everything is going according to plan. If anything, COVID was a way to have LIBOR transition faster. The shift in global markets and opportunities for China. As the weight of the world economy shifts from OECD countries like the United States to emerging countries like China and India, it is likely that the end markets served by GVCs will shift as well, with China being the most prominent future end market. This shift will bring substantial structural change to existing global value chains and provides both opportunities and challenges for China's upgrading. So anything that you've seen negative in the media, that's the challenges that we're seeing. Because again, it's a global operation. They knew it wasn't going to go smoothly to begin with, and here we are at the end of it all, and no one wants to touch the shit. So they got everyone scared. It's perfect. This is the reality, though. At least you've got a piece of it now. The media is here to deter you from opportunities. It's clear as day. The transition of China is almost complete.